we had about 51% of gold reserves relative to the debt problem that we had in the past. That would assume some insane numbers. If you do the calculation of if we ever go back to a debt problem that is actually backed by about 51% of US gold reserves, I don't think I want to be mentioning those numbers. It's in the chart. You can see it yourself. But, all I'm
I'm going to
saying
mention it
is,
just for the folks who are listening on the podcast who don't have
yep.
the visual here. Today, roughly 5,000 an ounce. Back around the 1980 period, as Tavi was talking about, implied price of gold of $26,000 an ounce. If we look at the metrics there back in the 40s, it would imply a gold price of $75,000 an ounce.
The relationship between U.S. gold reserves and the national debt suggests that current market prices are drastically undervalued relative to historical stability metrics. If the monetary system were to return to a scenario where sovereign debt is backed by 51% of gold reserves, a ratio observed in past cycles, the necessary revaluation would result in astronomical price levels. While gold currently trades near $5,000, historical data indicate that this figure is a fraction of the metal's theoretical value needed to back the financial system. Tavi Costa, macro strategist at Crescat Capital, breaks down these alarming projections. He notes that applying the valuation metrics from the 1980 peak would imply a gold price of $26,000 per ounce today. Furthermore, aligning with the debt structures of the 1940s would push that figure to a staggering $75,000. These numbers illustrate the immense gap between the current price and the levels required to structurally offset the U.S. debt burden, suggesting that any return to a gold standard would require a vertical repricing of the metal. Now, we present the clips from Tavi Costa's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Everything ties back to your views on metal prices eventually, and it ties back to gold itself, because gold is the big gorilla here that we should all be watching to sort of see where things move forward. And just knowing, I think it was Kathy Wood that put out a chart that showed the gold value, above ground relative to money supply in the U.S., and shown that basically we're seeing one of the highest levels in history in potential. She was calling for the peak of the cycle. If you don't mind, I would like to really address that, because I think it's institutionally important to understand what's happening. I'm going to share my screen again because I think it ties back to your question. Okay. When we looked at, that calculation that she did, we're looking at a US, money supply situation versus a global market of gold value. Well, that's not right. It's the same thing as me looking at, US technology companies relative to US GDP. That is also probably a chart crime as well, because most of these companies are global. So we should be looking at technology globally relative to the size of global GDP as well as part of this calculation. So let's assume the US situation for a second, which to me is a critical one, and is probably going to be also what's going to move the world. How much, instead of looking at M2, which is smaller than how much we have in debt outstanding today, debt is approaching $40 trillion now. I think we're 38.5 trillion. How much do we have in gold reserves? Well, if we use the prices that we're seeing right now, let's call it about $5,000 an ounce, which is about the range we're in. It's about 3% of the government debt, 3%. So, okay, well, that's an interesting calculation. Let's go back in history and see what we saw in the past. Well, back in the 70s or 80s, at the end of the last gold cycle of the 70s, not the last one's in early 2000s, but we hit at about 18% of gold reserves in the US relative to total debt. Back in the 40s, when our debt problem was just as severe as it is today, at about 140% of GDP on the public side of public debt, we had about 51% of gold reserves relative to the debt problem that we had in the past. that would assume some insane numbers. If you do the calculation of if we ever go back to a debt problem that is actually backed by about 51% of US gold reserves, I don't think I want to be mentioning those numbers. It's in the chart. You can see it yourself. But, all
I'm
I'm
going to
saying
mention it
is,
just for the folks who are listening on the podcast who don't have
yep.
the visual here. So yes, today roughly 5,000 an ounce. Back around the 1980 period, as Tavi was talking about, implied price of gold of $26,000 an ounce. If we look at the metrics there back in the 40s, it would imply a gold price of $75,000 an ounce.
Now, I know a lot of people may be, calling myself a lot of names here. I'm just using math. I'm not doing anything. I would call Kathy Wood and say, well, maybe, I would love to discuss this. I mean, I don't think that her calculation is correct. I mean, if she does it just looking at the US market today, where we are, this looks awful. And why not look at money supply globally? China alone increased money supply by $15 trillion in the last 3 years, okay, or 4 years. That's insane, right? I mean, the US, it's basically more than half of the US money supply, throughout history, has accumulated over history. So,
Jeez.
we really need to think about this from a global standpoint because the actual buyer of the metal is not just the US potentially. It could be, we know that other countries like China are accumulating the metal in amounts that none of us really know what it is. Prices wouldn't be moving the way they are if it wasn't for this. I think Luke Groman put out a great comment the other day where Scott Basson made a comment about how much gold prices have been helping the U.S. economy. Well, he's talking about this chart, right? I mean, he's talking about how much the increase of gold reserves is helping to back the overall debt. But we're far from an area that we've seen in the past that gave us some level of stability in the country for the fact of how much gold reserves we have relative to the imbalances we have. And so I don't know. I just think we're so far from those issues in terms of calling it the peak of the cycle. Look at charts like this. It's just to me, it's really what matters when it comes to the long-term view of this metal specifically.
Recent claims suggesting that gold has reached a cyclical peak based on money supply ratios rely on a fundamental methodological error. Comparing the total global value of gold against only USM2 creates a distorted picture. A more accurate solvency metric weighs U.S. gold reserves against the skyrocketing $40 trillion national debt. Currently, gold backs a mere 3% of this debt load. By contrast, during the 1980 cycle peak, this coverage ratio reached 18%, and in the debt-heavy 1940s, it stood at 51%. Restoring these historical levels of stability implies a gold price between $26,000 and $75,000 per ounce. Furthermore, the bearish case ignores the massive expansion of global liquidity, specifically China's recent $15 trillion injection into the money supply. Gold is repricing against this worldwide currency debasement, not just U.S. domestic figures. While current prices are beginning to improve the sovereign balance sheet, the data confirms that the market remains significantly below the valuation extremes seen in previous topping processes. Let's get back to the interview.
When you start looking at prices of what something is worth in this silver market, and on top of it, what you have in terms of the change in political environment we've seen in Bolivia, which was heavily discounted as a place where we would see nationalization and issues with the mine that we acquire. It's been the complete opposite of that. I went to meet the government a month ago, and I was just shocked by the capitalist agenda and the optimism that the team in general was looking to accomplish. And I think there's going to be a lot of good and positive things to come out of this. And I believe Bolivia might go from a discounted jurisdiction to maybe a premium jurisdiction as we see one of the most unexplored parts of the world potentially coming online and attracting capital from outside. Not only that, what I would also mention is, I wasn't the sole person who executed on this execution on this deal. Certainly, there's a group of very sharp individuals that were part of this, and that's the only way you can accomplish these types of ideas. And so, some people would see silver prices at sub, call it $15 an ounce or so, and claim that that's the time to be acquiring this. Every person will play it in a different way. I know very successful people that wrote a book about it, which was a great place to do it. Other folks decided to buy the metal itself physically. Others decided to do it on the future markets. Others decided to do in the mining space. And I did a lot of pretty much all the above, but one that I think the most rewarding one was certainly acquiring a mine outright with about 80% leverage at that time, which it was not only difficult to raise money in Bolivia, but also it was daunting with silver prices where they are. And so when you get those things right, and we triple a resource and we found a major discovery, and that's how you really create value. So excited to do this more often. I mean, it's not, those deals, people think that you can only do it once in life, and I don't believe in that. I think, especially now in energy and other places, I think that's where you can accomplish similar deals that we found in mining a few years back. You can probably find it today as well. So there's always going to be opportunities out there. We just got to keep our eyes open and try to structure the right thing at the right time. It's basically looking at the mining industry aggregated market cap relative to global equities. And you can see that the relevance of this industry in the past was, substantially higher than it is today. 1900s was about 10% or so, 70s and 60s was much, much higher than what it is today. We're down to about 1%. Global equities continue to go higher in values, which makes also the mining industry even less relevant over time. You can also look at the mining industry relative to gold itself, right? I mean, gold is now at a $35 trillion, or I should say $30 trillion market above ground. The mining industry remains really small relative to this. And so I would also argue that no other time in history, potentially, we've seen so much structural demand coming for mining at a time also when supply has been so tight. I mentioned a few things: artificial intelligence, onshoring, the electric vehicle revolution, the U.S. administration pushing for critical metals. I mean, the situation that we have with the debt problem, it's very clear to me that every decline we see in metal prices, it's being purchased by a very large player who knows who it is, right? I mean, I think we have some ideas who potentially is: central banks, other sovereign institutions, but things are changing. And I would say something even more important here, potentially, is we in the US and other places have been looking at the mining industry from a discounted cash flow, framework. And I don't think we'll be looking at that way in the future. I do think that more and more we're going to be looking at the way China is looking, the way maybe other places are looking as well, and the way that these places have been pricing some of these mining companies and others is from a securing metal valuation. And a securing metal world, none of us know how this is going to be valued, and this is not going to be, in my view, that's the craziness of the world that we might get into in terms of the relevance of this industry over time. I do think that sovereign institutions have begun to really realize, not just China, but even the US started to realize that subsidies and investments from the government are going to be absolutely critical to allow some of these projects to come online very soon. Why are we seeing? I think we should get into another discussion that is important too, because the dislocation is a lot of people have rushed into the metal space, and so you've seen metal prices go up significantly. Have they reached a peak? I really don't believe so. I think there's, in nominal terms, it's never the best analysis you can make. You should have said that maybe the S&P was expensive 10 years ago, but in nominal terms, it keeps going up. And the same thing it's happening with metals. None of us know from a nominal term where things could go, but from a relative perspective of monetary dilution we've seen globally, I think we're just getting started in this. And so I do think that the big dislocation remains in the mining space. And this type of behavior that we're seeing from governments right now, to me, is an acknowledgement of, money managers in the mining industry have always thought about this more, I guess, practically, in a way of, why buy the metal itself when you can buy for pennies on the dollar, if you find the right, operational team to execute on producing a certain commodity. And I think that most of these governments are realizing that too. Why should I buy gold, copper, and silver even in the market? I'm sure they're buying it too, but when I can also potentially acquire the metal supply
Right.
by
Buy it cheaply and lock up the future supply. Yeah.
correct. And so I think that's happening. And the only way to potentially explain the dislocation in mining stocks relative to metal prices today, which remain extremely cheap, is that the market thinks that metal prices will at some point come back down. And I couldn't disagree more with that. I don't think we're going to see, if we see a $20 silver price environment again, boy, I will certainly look for another St. Cristobal immediately. I think that would be a wonderful, thing to investors. But am I planning on that? No, I don't think that we're going to see that. In fact, I think that mining companies today, what we need to keep in mind is that a lot of them let's speak on the silver side for a minute. A lot of these companies are still, their cost structure is still sub $15 an ounce, right? $15 an ounce. If metal prices, every day we see metal prices at about, I don't know, above $50, it's a good day that we should be celebrating, because our margins are better than Google's margins, are better than Facebook's or Meta's margins, are better than Amazon's margins. We finally have technology-like margins in the space that we've never probably had. And so it's a wonderful environment for those that are in that business. And I think this will continue to be the case here.
The mining industry currently sits at a historic valuation low, representing just 1% of global equities compared to over 10% in previous decades. This extreme disconnect exists despite unprecedented structural demand drivers, including artificial intelligence, the electric vehicle revolution, and sovereign debt concerns. While global equities continue to climb, the mining sector remains disproportionately small relative to the $30 trillion above-ground gold market, suggesting it is primed for a massive mean reversion as capital begins to recognize the acute scarcity of raw materials. Furthermore, the market is severely mispricing the profitability of silver miners, who are currently enjoying technology sector margins. With production costs around $15 per ounce, while silver trades above $50, these companies are generating free cash flow superior to that of major tech giants like Google and Meta. The current valuation gap implies that investors fundamentally misunderstand the sustainability of these metal prices, fearing a return to lower levels that macro conditions no longer support. This environment offers a rare arbitrage opportunity where operational leverage is set to deliver exponential returns. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.